I've been in the commercial real estate world for 22 years now.
So over the years, you've arranged over like 1.3 billion in transactions across like various property types.
Getting to the finish line was a massive celebration. Everyone was pleased.
What was the dollar amount? Just for
That deal was roughly 15 million.
the deal's not closed until it's closed.
That's right.
That's
That's exactly right.
You cannot celebrate early.
No.
You got to get
You
it through.
gotta-
I keep it simple. I invest in multifamily. I invest in what I know. Invest with some of my clients, selectively. I pick my spots. I go grind every day.
Yeah, that's right.
Top line.
Welcome to another episode of the Cashflow Quest, everybody. Today we have a special guest, Aaron Beck with Northmarq San Diego. He is the managing director, and we're excited to have you here today. Thanks for coming.
Thanks for having me. I appreciate it.
Thanks for joining us. We're excited to talk. We got talking and we were like, all right, we got to get up. We got to move into get it on the show.
I
don't want to cover too much ground off
Yeah.
camera because it's some fun stuff.
Yep.
Yeah,
so,
for sure.
Yeah. How did you guys want to start in?
Well, I've known Aaron for probably going on 3 years now. So we met through the USD real estate program, and Aaron came in and spoke at our capital markets class as like a guest lecturer. And I just was really impressed, and we became buddies ever since and industry friends, but just impressed with the way you explain just capital markets in general. And that's obviously your main role, running the San Diego office for Northmarq capital markets, so sourcing debt and equity. Probably have a long-standing track record and expertise in multi. So we'll probably spend a lot of time talking multi because it's an asset class we really enjoy. I have a lot of our clients that invest in multi. Blake and Jen personally invest in multi and have some multi in their portfolio. And it's a good comparison, I think, to mobile home parks as well. Mm-hmm. So we'll probably, I'd love to just jump in really like how you got started in the industry, like your origin story. And then I'm sure we'll get more technical as the conversation progresses, just knowing us are all deal folks in this room.
Perfect. Well, again, thanks for having me. Pleasure to be here. So I've been in the commercial real estate world for 22 years now. Started in the business, valuing assets. That's really where I learned to build models and cash flows and, look at investments various ways, get into the debt and equity side at the project level. What
was your first job to do that?
So I was an appraiser.
Okay. I was gonna say appraiser, but I wasn't sure. Yeah.
Yep. So that was my foundation. Yeah.
Yeah, there's a lot there. You would learn a lot about the industry and property dynamics and things being an appraiser.
Yeah.
So.
What creates value, all the variables that add to it or take away from value. And through that process, I would not trade it. First of all, I had my head in spreadsheets constantly.
You have to model it, to go to the income approach. And then you're like, okay, what's the market cap rate? And yeah.
So that was my foundation. And I'd say within 3 to 4 years of that, I knew I had to be in that seat for a while. I knew that I needed to learn the nuts and bolts.
Yeah.
And it was very clear to me. And that was, after 3 to 5 years, that was right in the middle of the great financial crisis.
Okay.
And there was no way I was really going to leap at that point. And so I stayed put, networked in the San Diego market. And, opportunity came across my desk 2010-ish to go on board and be an analyst for Northmarq. The office was new. But the individuals who were running the office had been in San Diego, knew all the players, very well connected. And so I jumped at that opportunity and sat in the analyst seat for just a couple years. And then
that was early Northmarq. What year are we talking?
So they opened the office in late 2009.
Wow.
And then I came on board at the very end, very end of 2010, very beginning of 2011.
Okay.
And so I was in the analyst seat for just a couple years. And then they let me fly and go build a book of business.
And Northmarq's it's not a publicly traded brokerage company.
Correct. It's private. It's owned by a large family out of Minneapolis, the Polite family, and they also own the Minnesota Twins.
Oh, no kidding.
Yeah, they do. And then they own a handful of other operating companies. But fantastic family, privately owned. Company's growing tremendously.
Oh yeah.
So I got invited to a Northmarq event, and we were probably there together at Park City.
Okay.
We closed a deal when they just started kind of going into MHC
Yeah.
in Arizona, and they had bolted on a couple of salesmen from different angles to run MHC.
Yep, exactly. So it's been a good run. The company's growing, and national presence, all the major markets. And so it's fun to watch that. It's fun to be a part of that. There's been a lot of exposure in the marketplace. So, onward and upward.
Yeah.
So over the years, you've arranged over like 1.3 billion in transactions across like various property types. What's been the most like memorable or challenging deal that you've worked on?
Yeah. Today, I think we're probably close to like our team, like around 2 now.
Okay.
2 billion in debt and equity financings. Probably one of the more challenging, or memorable deals was probably my first one.
Yeah, I was going to say
my
that.
my very first deal back in 2015, and it was a multifamily development deal in San Diego, and it was a client that was connected to USD, who I had, as a younger guy, been chasing for a couple years.
This was a bigger deal for you in this moment as your first one.
Absolutely.
Yeah.
Right. And I will never forget getting the call, and the 2 guys who started the company said, "We'd like you to do the financing, the takeout financing, take out the construction loan."
For the construction loan.
And that's big. That's your first one,
and
right?
you've been working this to get that phone call.
Yeah.
Like that was the final.
it was probably 12 plus months.
Yeah. Vote of confidence. Okay. You're our chosen path.
Yeah, absolutely. And so ended up being a Freddie Mac loan.
Okay.
And the unique aspect of that was that this was when Freddie Mac had just come out with their what's called a near stabe or pre-stabilized product, which allowed someone to get permanent financing before you reach stabilization.
Like which 80% occupied or?
Yeah. So really it's like 70, 75. Once you hit a 1.0 debt service coverage ratio, it kind of ties to those, right? So in this instance, we were probably, 2 to 4 months before, the typical seasoning that's required of stabilization. So time is risk, as everybody knows. So you take some risk off the table and do it sooner. And so that was my first deal. And like I said, that was when Freddie Mac had just kind of released that product in the marketplace.
And Freddie's tough, dude.
Yeah.
I just feel I think Freddie runs a clean process, but like it takes you a while, and there's a lot of details and a lot of box checking.
There are. That's true.
Yeah. We talk that Fannie's easier to execute on.
Okay.
But sometimes Freddie's just the clear winner.
Both of the agencies have their pros and cons, right? Because they execute differently. But I can tell you, groups like Northmarq, that's why we're there. Because we're experts at it. We understand the intricacies. And once you get a rep or two, as you know, you've done both Freddie and Fannie deals. Once you have some reps in it and you have a group who has been an agency lender for a long time, it's just kind of like on a conveyor belt.
Yeah.
You're just going through the process.
First deal.
Yeah.
And you're pre-seasoned. You're not quite seasoned.
So yes,
go ahead.
Exactly. Thank you for leading me to the water. It was a client, a first deal with the client's first agency execution, and a new product type. And so it was a fun execution. Getting to the finish line was a massive celebration. Everyone was pleased.
What was the dollar amount, just for fun?
That deal was roughly $15 million.
Okay,
nice.
Yeah.
Nice
Hey,
deal.
it was a good deal. How many units? Do you remember how many units the property was?
68.
Okay.
Yeah.
Here in San Diego.
La Mesa.
Oh, La Mesa.
Nice.
La Mesa.
Okay.
The
cool.
zone's getting smaller.
I'm not giving up the address.
Yeah.
We could probably get pretty close.
I know, exactly.
And then like receiving that commission check, I bet you had to feel so rewarding as well. Just like, one, it's
Yeah.
like delivery. I mean, it's probably not as rewarding as someone giving you the opportunity, especially like someone that's more seasoned, building a relationship with someone. But then, you work pretty damn hard in real estate, and that's like being persistent. And
Yeah.
these deals, they're not overnight, like some of
No,
this stuff
that's the
takes-
equivalent of us getting a deal in escrow.
Yeah.
It's like, okay, we now have the opportunity to do it.
Yep.
Yeah.
But like, you work your butt off to get there.
Yep.
And then you got to close it.
Yeah.
And a deal's not closed until it's closed.
That's right.
That's right.
That's exactly right.
You cannot celebrate early.
No.
You got to
Yeah.
get it
You
through.
gotta-
Yeah.
Yeah.
Did it record? Are we done?
Yeah.
From the escrow company.
Yes. So the sales cycle, right, can be lengthy. Some are shorter than others, obviously, but it felt good. And then you're on to leveraging that win,
Right.
right?
For sure.
On to,
Yeah. Blast.
there you go.
Just closed.
right?
Yeah.
So,
Yeah.
yeah.
Cool.
Those are good memories. Thanks
Yeah.
for allowing me to talk about that.
Good. I like to go down memory lane
Yeah.
sometimes. Yeah.
So how much of your business has been multi versus, do you do MH?
We do, right?
Okay.
Internally, we do. And
But your still main focus is
main
multi.
focus is multifamily.
Okay.
I would say from call it 2015 through 2018 or 19, probably half of my business was multi. The rest of it was a combination of industrial, maybe some office,
Mhm.
some retail, a little bit of self-storage. And then after, post 2018, 2019, call it the last 6-7 years, it's really shifted to probably 80 to 90% of my business. I still do everything.
Yeah.
I closed an industrial deal this year, and am working on a retail deal
Okay.
right now. So still do it all. And our team,
Is that agency business?
it's agency. So Freddie Fannie, there's conversations about HUD. We've done some HUD stuff
Yep.
out of our office. And then insurance company,
Mhm.
bank, and we still look at bridge.
Mhm.
Mhm.
So it's all the above. I think that's the challenging place in the market today is that it requires someone to go to all the capital sources. You just have to.
Yeah.
You have to, check the box because
Well,
you just never know.
Well, we've been, we've had a lot of internal conversations. And over the last few years, we've been riding this wave. It was like, okay, Freddie had a run.
Yeah.
And then CMBS came out of nowhere,
Right.
and you could buy the rate down, and it was like, oh, you could do interest only DSCRs. There were some new tools.
Mhm.
Yeah.
So we did a few CMBS deals, strung a few together,
Okay.
and then we're back into Fannie.
Yep.
Yeah.
And then it's momentary because I actually think the window's closing. So we did some small spread, like 100 bip spread,
Mhm.
Mm-hmm.
Fannie moderate leverage,
Yep.
where the sizing was kind of coming closer to the one, the regular sizing.
Yes.
So it was like this
Yes.
moment in time.
Yeah.
Well, I think that's gone. I just got a quote at 140 spread
Oh, really?
for Fannie moderate. So
Okay.
With the buy down.
interesting.
so we're riding
With the buy down?
Well, so I don't know yet. This
How
is
much-
super early.
Yeah.
Okay.
But can we still buy down? Is Fannie still doing it?
Oh yeah.
Okay.
Absolutely.
So
both Fannie and Freddie.
okay.
They are. And in fact,
But like spreads, historical lows.
yes, with the buy down, I mean, we're seeing spreads, sub 100,
Yeah.
depending on leverage.
Yeah.
Right, I mean,
We've closed
which
at
is-
93, 97
Yeah.
bips.
Yeah.
Yeah. I mean,
Yeah.
that's absolutely right.
Yeah.
Right. And it depends on the term between Freddie and Fannie because, with the buy down, when you get to the shorter term loans, Freddie allows more of a buy down
Yeah.
versus Fannie. But some people want 5-year deals. Some people want 7, some want 10. And here's the other thing that's coming into play now. Also is that Freddie just modified the way they look at, the way that they're sizing their floating rate loans. This is really interesting,
Ooh, I'm
fascinating.
excited.
Yeah.
So
My ears just perked up.
So there's ultimate flexibility in that, with a Freddie Mac and a Fannie Mae floating rate loan. But Freddie Mac in the last 2 weeks, the big news is that they eliminated really the primary constraint of loan proceeds that they had been using for the last couple of years on floating rate loans. And so now you're getting to more leverage.
So what changed? What's the structural change there?
Well, so
we had a few floaters, just so you know, so we're familiar.
Yes. So they required you to underwrite to a 120 cover at the it was at the actual pay rate at
Amortized.
the time. Yeah. Over a 30-year AM. That's how they size it. Well, that was a limiting constraint,
Yeah, heck yeah, it is.
right?
Yeah.
Why? We're not paying principal, but you're sizing it off principal. I get it's conservative there, but
so they eliminated that, and so now it's just helping the loan amount, increase. You're getting to higher leverage with the.
How much of a swing? Roughly 5%.
I would say it depends on the marketplace, right? Because it depends on cap rates. That it's really dependent on that. But I would say anywhere from 3 to 4% to some of the areas where cap rates are higher. It's probably a bigger swing than that.
Wow, upwards of 10 maybe.
Yeah.
Yeah, I don't know about that,
Okay.
but yeah, I mean those are great questions, but time will tell. But it's so what it is really sizing.
So it's 120 on interest only payments.
So now it's sizing to what's called a fixed rate equivalent, FRE.
Okay.
That's an acronym, right? Agencies live in a world of acronyms.
Real
And
estate
so-
in general.
Right? So it's called, so now really the limiting constraint is going to be FRE or fixed rate equivalent. And it's exactly what it says it is. So you size it to a 125 cover, right? At the equivalent fixed rate,
Interest only.
amortizing.
Okay.
So that's how you're going to size loan proceeds. That's going to be the constraint. Now versus what it was the actual pay rate to a 120 amortizing debt service coverage ratio. You remember the floating rate interest rate was higher than the fixed rate.
So the spread comes into play on the all-in rate, fixed rate equivalent, or is it?
Yeah. So what you do
Or
is
is it
you
the treasury? I guess. What are
It's
they?
both.
Okay, so
Because you
then,
come to a fixed rate, right?
so
And
like
the
let's
fixed rate
say
is made
rates
of
were pushing. It's 5.5 to 6 right now, roughly for our game. So what would you use? How do you pull that data? 5.5 or 6?
So they would, if you went to Freddie and said, I'm going to do a floating rate deal, and let's just for round numbers, let's call it a $10 million deal.
Yeah.
Right. $10 million. And you say, I want floating rate. And they say, okay, well, if you were to do this deal today and you wanted a fixed rate, we'd give you a spread again for round numbers, 125.
Yeah.
On a 5-year deal.
Yep.
And the 5-year index is at 410 today. Right. So you're at 535.
Got it.
So then they're going to take the 535, take their estimated NOI, and apply a 30-year amortization to that to get to your loan proceeds.
I get it. Well, so it's basically focusing on the takeout loan, in a way too, because if you, it's like you fix this or standardize the process.
Yeah.
And then you go back to a floating rate because the floating rate's more right now.
Floating rate is more what?
More total all-in rate, I think.
Yeah, it is. So, I mean, we have SOFR at roughly 430, right? And you're going to have spreads on a floating rate deal of, call it 180 to 190, just ballpark-ish.
Yep.
180 to 200.
Yeah, it's
Over?
going 200. So what is that? 6 and change.
Yeah.
Yeah. So it's higher, but
You're getting
what-
more proceeds.
but you're getting you're getting proceeds and you're getting flexible prepay.
Yep.
And what does the forward curve say about the floating
Rates
rate index?
going down.
Yeah.
Now, how much are rate caps?
They've come in
All right.
tremendously, right? Because what does the forward curve say?
Now,
Down, yeah.
going down.
I have a theory. All right, this is just
Okay.
a fun one. So we had a few floaters, and it was right before my dad passed, and he's like, I don't like this idea. And I had a buddy at the time working for Bricadia, and he's like educating the heck out of me as he's kind of growing his knowledge of these floaters too.
Yeah.
And so I go back and I'm like, okay, well, all right, we'll do it, but we want to buy an extra year. So we bought a third year of rate cap coverage. Well, we ended up needing the third year. On one deal, we ended up selling, getting out of it a year early. So we had 1 year of like a whole, rate cap coverage left. We ended up making like $130,000 on that rate cap for 1 year.
Yeah.
You know, and it was a $4 or $5 million loan.
Okay.
Then we needed a couple. On the 2 of the other deals we got had floaters on. We needed the extra year to get to the income level to do the fixed rate takeout because it was a nightmare. Every time we'd size, it would go up.
Yep.
So like, I mean, it was just we were chasing our tail for like a year trying to get out of those damn floaters as they were pulling all of our reserves for the CapEx. You know, you don't have a choice. They pull them.
From bank
Exactly.
accounts.
There you go.
They pull all your money basically, or whatever the equivalent is, the rate cap.
Cost,
They
replacement.
store your money so they can go pursue the next 2 years of
That's
rate
right.
cap purchase.
That's right.
But then what they're sizing that cost and getting quotes, and it's astronomical in that moment. So that was like the really unfun part of it. But what I learned is like, okay, if I do a floater again, I'm just going to buy extra rate cap coverage.
Okay. Yeah. Beyond what
A
they
hedge.
require.
Yeah.
Yeah.
And it's like, well, if we want it for 5 years, we could just buy a 5-year rate cap. Now you might spend and waste that money, but I'd rather have it
Than not.
Yeah.
than not if rates went the other way
Yeah.
and you chalk it up as insurance.
Yep.
You know?
Yep.
So what do you think about that?
I mean, I had a client that did that on a development deal, multifamily, that went out and bought on their own during the construction loan process, right? The deal was under construction, and they went and bought a hedge. And so,
How long ago or when was that?
I mean, that was back in 2021.
So he ended up
22.
making money on those things.
They did. They made some money.
Yeah.
They made some money.
So he looks like a genius.
Yes.
And it was
Yeah.
cheap as hell.
It was.
Like, I'm like, why didn't I buy more of it?
Yeah.
Because
I mean, pre
it was
20
like $3,000 a year.
Well, they were giving you a hard time for buying the third year as it was. So
Yeah, it was like very
wasn't
abnormal. So I had a
you
little bit of
weren't gonna
pushback.
buy more. Yeah.
Still,
But I mean,
like,
pre 2022, before the Fed started raising the short term, rates, I mean, these things we're talking 10, 20, 30, $40,000. That was cost of it. Right.
Yeah.
And then
but the additional years got cheaper. You know, so if you're willing to go and be sort of like the idiot, it was like, if you want to buy it, we'll sell it to you.
Yeah.
Right.
It was like one of those things.
Yeah.
So I'm like, well, I want an extra year just because it might take us that long.
Yep.
But in hindsight, like,
Should have bought 2 more years.
I would have bought a couple more. And then
more.
You end up actually, if you have the hedge and you need it, you end up being able to solve for your proceed challenge in a way.
Yeah.
That was fun.
It's an interesting thing.
Yeah.
So the floating rate product with Freddie, I have not, that change was made 2 weeks ago, and I have not heard that the floating rate, like the inflows of floating rate requests have gone through the roof.
Yeah.
But I think it's very smart. I think it's in anticipation of indices, the short-term index coming in, SOFR. And when that starts to happen and there's a taste of that, I think you're going to see some shift in the marketplace away from fixed rate to floating rate. A lot of that because of the optionality to move it to a fixed rate after the first 12 months.
And then just so you guys know, they waive if you do a Freddie floater and then you go to fixed, they waive the 1%.
That's right.
So you not only don't have a prepay, they waive the 1% cost.
Yes.
If you go to a Freddie fix.
Yeah.
Gotcha.
Yep. So it gives you ultimate flexibility.
So this would be like, this product would be interesting when going in on a deal that has very like low in place rents to current market. So we see those deals sometimes. And so, and no one's going to give away the deal, right? So, so you're going to negative leverage, but say you have to raise 60% of the equity. If you were to fix rate, do something more fixed rate, and do kind of the more traditional lending. So that could be interesting optionality to get to a 1 year rent bump or 2 years of rent bumps. So then you can go and then take out that floater pretty quickly, get into more permanent
rates
financing
start coming down.
Yeah,
too.
because if you're going to hold like a lot of our stuff, like we're buying this deal in Phoenix right now, and I'm talking to clients about it, and they're like, so when do you think you'd sell? It's like, we're going to put 10-year paper on it. Probably for 10 years. Unless I find something better for you to put your money in, because we do the 1031 exchanges, right? And so long term thinking, it's like, well, we're not going to just flip this deal and then Blake's managing a 1031 exchange, and then where are we going to go place that money?
Right.
And so Phoenix is very difficult to access deal flow into. But this is going back to that same example, but maybe I wouldn't want to be at 40% LTV on a 10-year hold from an overall return standpoint, right? Like,
so let's talk about the alternatives.
Yeah.
Right. Just given the facts. So the options are, if you wanted to go agency, you can do a fixed rate deal. And after 12 months, if you have bumped rents, anytime after 12 months, you have bumped rents and you've realized increased cash flow, you've improved operations, then you can go do a supplemental, right? That's the other option. If you didn't want to put the entire capital stack at risk.
Yep.
Right. And you are comfortable with a portion of the capital stack and you want that and you just don't want to take the risk of the entire capital stack, then that's probably the route you would go. Versus if you're
talking 10-year fixed.
Yeah, sure.
And then you have the optionality of a supplemental.
Yeah, you do after 12 months. Yep. Or so you get more dollars through a supplemental. So it's like a second mortgage and you take some chips off the table, you get more debt, add on to the senior. Or if you're really convicted that after 12 months or down the road that you have a conviction about the business plan A, and B, you have a strong opinion that rates are going to come into us and that you don't want to fix that portion of the capital stack at an interest rate that you think is higher than what it's going to be 12, 24, 36 months down the road, then you do a floating rate deal, just what we talked about. And you probably get to similar proceeds, but you're going to be able to revamp the entire capital stack after 12, 24, 36 months and fix it in at no prepay, assuming that you went and fixed it with Freddie again, who you did the floater with, right? And I think all this is to say Fannie Mae has a floating rate product as well. They do. And historically, Freddie's floating rate product has been utilized more than Fannie's. But there have been times where Fannie's product has been competitive as well. So we can't forget that in the marketplace. But
it kind of ebbs and flows with their business model, right? Like where they want to allocate capital.
It does. It does with both of them.
I know. Yeah, it's kind of this weird wave.
It is a weird wave, right? We have to remember that, Freddie and Fannie are given goals every year that they have to meet.
Yeah, so it's hot. I feel like they both bid hard for 6 months of the year.
Yeah, the first.
And then depending on how that first 6 months goes, one will shift in the later half of the year.
I mean, that's true. And I wouldn't say later half of the year. They shift throughout the year.
Yeah.
And it's just constant jockey throughout the year based on where they are.
How much allocation they've had.
That's right.
I think this might hold true, but it's not exact, which is going to do deals in the third and fourth quarter always size way worse.
Not this last year.
No. So, but I'm going back.
Oh,
for 10 years.
Oh yeah. I mean,
where it's like when they're full or they've allocated their allotment for the year. They're kind of like, and the spread's higher. And it's just kind of like this. The quotes aren't as sharp, I'd say.
They don't have the need.
No, with how slow deal flow was, I'm with you. Like it was completely,
absolutely
a bidding war, let's say.
Yes. So true statement.
Yeah.
Yeah. So it all has to do with where we are in the cycle.
Yeah.
That's what it has to do with.
Early on, this was a nightmare for me to figure out. Like, you kind of, you keep wanting to lock into like, okay, when we buy a mobile home park, you go through this process, and I didn't know how the debt game worked until we basically did it all. And then you realize like, oh, it's a very dynamic beast. Like there's no way to know like, oh, this is the product. Like you even said that the other day, like, hey, give Austin's our controller. Yeah. Like Austin would like a heads up, like what we're thinking. I'm like, well, until I have quotes, and I start talking about each deal, it's different every time.
And it's an interesting question too, because people will say, well, how do you decide what kind of debt to put on the project? And it's like, oh God, well, let's get our quotes back, because depending on the year or the cycle, like the offers of all these loan quotes are going to come in different with different terms depending. So we really can't give our controller an answer until we see the loan quotes. And then our analyst plugs it into our performa and we can kind of analyze each one and, look at them.
And then the last two things, it's like, all right, what's the business plan
that 100%.
We're trying to execute? And then what do we think about future rates, which I would put as the last one, right?
Yeah.
like
because
Anna,
it's so hard to,
And it
I don't want
depends
a
on
crystal ball.
Yeah.
we
And the
bought a
prop-
deal
Mhm.
just to run a hypothetical where
Yeah.
we can talk about it.
Totally.
You know, it's ours now. We bought a deal last year that was $400 space rents in a market that could be clean 800 all day.
Okay.
And so that was a tough one because it's like, we don't want to really put 10-year paper on it.
Mhm.
Yep.
We'd rather do something shorter.
Yep.
So after
Mhm.
running around, the floating rate game was still shaky last year. And everything was like, and how much our rate caps were still expensive. But then
Right.
we're kind of like in still the shock and awe moment. And so we decided to go fixed rate 5-year CMBS
Okay.
on that loan. That way we'd work the deal for 5 years and then transition it.
Yep.
And so we did that, but now it's like Anna would be a good conversation.
Yes.
Real time on this float, going back into floaters, but then you just buy additional rate cap coverage if it's not crazy.
And
Yeah,
like, we talk about this too, like, and everyone was like, wow, why would you ever buy 3 years out of caps back then? Because everyone's like, no one's doing that because no one thought that the Fed was going to increase the Fed funds rate faster than they ever have in history. Right. And so it's like that black swan event, but I would just feel more comfortable at night, especially like talking to our investors and then being able to sleep, spending up for the insurance. And then that way you're not freaking out and sweating when, something goes up and you see the 10-year blowout, or you're like, oh, inflation is a lot higher. The Fed isn't going to cut rates, And so I just think it's a smart play to just hedge. And even if you give up some returns, it's like, I would rather and I think as long as you have a good investor base, that's okay with that. I'd rather like preserve capital probably more than generate outsized capital, right? Like I would rather not lose someone's money.
I think another way to look at it, perhaps, is the additional risk that you're taking without the hedge.
Yeah, is insane.
Are you getting paid for that additional risk?
Yeah, that's a great way to look at it.
I would say, historically, now in hindsight,
and if you're not, then why wouldn't you do the hedge, right? Because your returns are probably still very viable.
Mm-hmm.
And then you can speak with more certainty to your investors about the returns that you're projecting.
Well, and you have a baseline, more or less a baseline confident return.
That's right.
Versus,
because it's certain.
we think we're going to hit a 20, and it's like,
right.
But the risk is crazy.
Yeah.
Yeah. I mean, this probably leads us into the next part of the conversation. And I mean, we're just at a place where volatility for everybody is high. And, just let's call it what it is. It's hard.
Mm-hmm.
There's a mess going on the debt side on who holds the paper right now, which is what we're kind of talking about, and how to exit or refi and all that.
Yeah. So, I mean, to the conversation here, how do you figure out what kind of debt you're going to do? Well, the answer is it depends.
Right.
And what I told you yesterday could be different today. And so it really is truly real time. And that's the challenge, is the shifting marketplace and making decisions. But on the topic of boxing risk, if you can box your risk, what's the worst likely downside and what's the best likely upside, and you're very confident in that, and you're confident in between that upside and downside, that's where the deal gets done.
Mm-hmm.
Yeah. We've been focusing a lot more on the security of having lower leverage, more cash on cash base focus.
Yes.
Because it's like, this is all pie in the sky. Who the heck knows in 10 years what interest rates are going to be?
Yeah.
And I would say, like, I'm unwilling to make that bet. So then it's like, well, we'll fix it. Our income, we know in 10 years is going to be sound. Then it's just how much can we refi, or how much can we sell it? How much profit can we sell it?
Yeah. I don't think this is the time to be hedging a bet on interest rates.
No.
There are other things to hedge your bet on, right?
Or taking the risk, you mean?
Yeah, that's what I'm saying.
Yeah.
Yeah. Don't take the risk on predicting interest rates today. That's not the right variable to predict.
And like, we got our fixed rate. The last couple of deals we did were moderate leverage Fannie, 55% LTVs. We got them, 5 and in 5.3 range, let's say.
Yeah.
Like, historically, that's a great rate. Interest only for 10 years.
It's a great rate.
It's like,
It's a great rate.
Okay, chalk it up, close it, let's move on.
I think the great thing about that as well is, you can tell your investors with a great deal of certainty, and that's why they get paid, because they're taking risks. So you never want to tell someone or make them feel like
There's no risk. You're low
but
risk.
that's what they're getting paid for. But the certainty of their yields, pretty high.
Yeah. And just giving you a real example of that, like how that transcends to what I do, which is going to speak to investors. One of our bigger investors didn't do any mobile home parks. I knew him personally. It was like a good friend, mentor, and did a lot of multifamily stuff, still does. And he tested us out over the last couple of years and puts in like $500,000 per deal kind of thing. And I give him a call on this latest deal, and we're kind of talking through it. And he's like, yeah, I'm getting some capital calls right now. So I just got money that's kind of getting pulled from all different directions. And I was like, talking through about the deal. Like, sorry to hear that. He's like, yeah, but they're good deals. Like, I believe in the operator. I believe in the story, and I believe in kind of the market. I was like, yeah, it's really a financing game and just kind of capital stack. And he's like, remind me again how you guys do your financing on these deals? I was like, we fix rate 10-year paper. And he's like, I really like that. And now he's been like doubling his allocation with us. And so it kind of shows that sometimes like just being persistent in something, like, cycles are going to, like you're talking about cycles, right? Multifamily is going to go on another tear, and maybe MH isn't going to be able to compete on the same, like apples to apples from a risk return spectrum, because maybe multis just is running, right? So it's just, that's where the true alpha is. But cycles ebb and flow. And so when you find those folks that, not the tide isn't rising. Yeah. That's kind of when you can start to really grow a business, going back to like, your origin story, just like being persistent and kind of staying that track. And that's like, hey, you grow a business over a long duration. It's just like managing risk and just being persistent in what you're doing. And you really start to build a following of folks that trust you and know that, hey, maybe I could get better returns elsewhere. But I know you're not going to lose my money, and I like working with you, and I trust you.
That's exactly right.
Oh, and I mean, gosh. So the people that survive this multifamily, the younger guys that didn't hedge, if they survive, they will be far less willing to take that risk in the future, because like, also I'll give them the benefit of the doubt. There was so much bridge money. There were so many guys pitching that for multi, it would have been hard not to take it.
Yeah. Yeah. It was frothy. I mean, there were dozens and dozens of bridge capital sources in the marketplace,
and they were selling good. They had a good product in the moment.
They did.
And so like my point is it would have been hard to ignore if you were an operator,
and you wouldn't have got the deal done.
Well, that's what that's what it is.
Yeah. So if you want to win the deal and you're like, this is a great deal, it's a class A 200 sites in San Diego. One of these comes on the market per year, or whatever, better than I would, but like,
yeah, it's a good example.
Yeah, it's like, well, we're going to get beat if we don't.
That's exactly what it was. If you wanted to play and you had dollars you had to put out for investors, then to a certain degree, your hand was a bit forced.
Oh, it was a pickle.
To do it, right? But I will say that, my clients, many of my clients really didn't play ball. During that time with the bridge.
See, the older guys, the guys that had seen some challenge before didn't take the money.
I mean, I had some, don't get me wrong. And I think they're doing fine. They're working through it. But those groups that stuck to their guns and were convicted about not veering toward the leverage and chasing these low cap rates with higher yield, higher leverage debt and all the rent growth, they are sitting pretty with a lot of fixed rate debt right now
at 3%, 4%.
And these are the groups who now are ready to buy. They're back in the game, right? And so
but they're not selling those deals that are.
No, those are holds.
Yeah, exactly.
That's their mentality. So it's a different mentality, right? And these mentalities or these thoughts will continue to ebb and flow. Look, we'll come full circle. It's part of the cycle. It'll look different, but there will be some similarities to what we experienced over the last 5 years. It's the way real estate works.
If people start jumping back on the floating rate game hard, though, that'd be pretty wild. And not hedging again, will they learn?
Yeah. And I think that most lenders required a hedge. But the problem is that when the hedge was up and the cost to renew it, there was no money to do it.
Yeah.
Or the money to
got
do
ridiculous.
it. Yeah.
The pricing got like
so
spooky high.
the cost of it really just ate up a lot of liquidity, right? There were capital calls, on and on.
Mm-hmm.
Cash in refis, which has become a big thing that you hear now. Not cash out, cash in. People are having to refi out of this and do capital calls to then bring in additional equity.
That's right. If you want to refi.
If you want to, but yeah. And so,
if you want to hold it, if you don't want to sell it.
Exactly. Yeah.
Tough decisions.
So we, off camera, we kind of laid it out. So, okay, if you want, why don't you do that again? Where you laid out, like, you bought the property for X, you had a loan on it, but now you're in that pickle.
Yeah, with regard to the floating rate or bridge money that really took off in the latter part of 2020.
Right.
And then kind of came to a screeching halt in mid 2022. So there was a 24 or, give or take month period,
Mm-hmm.
window where there was a lot of money in the capital, or there was a lot of capital in the marketplace, right, chasing deals. That was the reality with very low interest rates. So it was this perfect storm of driving values.
It was a stock bid up. I mean, it's similar.
Yeah, yes.
Like chasing Tesla stock up through the moon.
Mm-hmm.
Like it's like the P ratio sucks. Like, what are we doing?
Yeah. So again, a lot of money in the marketplace. It was virtually free money. There was rents were taking off, and this was like a hockey stick type of growth.
COVID perpetuated rent growth.
It did, and so you have
dynamic pricing, all the cool systems we have now. Like, it ran rates.
Yeah, I mean, you had every variable virtually
clicking
that you could have had going in the right direction.
Yep.
And when you combine that, that's not a straight line value growth. That's a exponential growth in value. And that's what you saw. And because cap rates were compressing with values increasing at a higher rate than the NOI was, right? You had cap rates compressing, and the only way to buy an asset at that time and to get leverage was to do floating rate loans. That's the only way. If you were to go to the agencies or the insurance companies or to the banks, fixed rate product, you were getting to maybe 50% leverage.
Right.
Yeah.
Maybe. And it was wild.
Typically, out of that perfect storm, you were saying too, you're getting to 60 or 70%, not barely to 50. So that's a big change.
They drove bridge, went up to 80.
Yeah, which was nuts. I remember we looked at some of those and we're like, holy cow.
There was some bridge. We honestly got lucky in manufactured housing because the bridge money was looking for deals, and they started pinging us, and I started having bridge guys reaching out to me all the time.
Yeah.
But whenever I'd flip them over the financials and how it works, they we just can't get comfortable with mobile home parks.
Okay.
Like, they just didn't know enough.
Got it.
And so it never really penetrated MHC.
Yeah.
Interesting.
Maybe a couple guys had them on the higher level like fund management side. Mm-hmm. But when it came to like a deployment of capital from a bridge standpoint, they didn't do it.
Yeah. So, I mean, that was the way that deals were getting done because people didn't have the money. The yields didn't produce the yields to come in with 50, 60% equity, right?
Mm-hmm.
We all know that. That's why we use leverage, because it helps our yields.
Mm-hmm.
Yeah.
But they were borrowing even then it was 7-8%. It was expensive.
I mean, back then when we were doing deals in the, all-in rate in 2020.
5?
I mean, we were 3s, 4s, and 5s.
375. I saw even when I was at BlackRock, I saw some.
Yeah, you're testing my memory. I feel like, that was back in 2020.
That's cheap bridge money.
In 2021, I mean, you got to remember, SOFR was next to like
it was zero.
Nothing.
Yeah. It was 0.1.
And so then you had a spread of like, I remember seeing spreads in the 300s, and gosh, I mean, don't quote me on this, but I could have seen spreads in, just the high 2s as well. And it's just like, so you're all in coupon, is
maybe it was 3-4.
Yeah, you're in the 3s, right? in the heyday.
At 80% leverage or whatever, 78% leverage.
And then the stabilized debt yield was incredibly low, getting you to, 70% plus of the cost.
Too.
Of the cost.
That's keyword,
but, a lot
of your CapEx and all your bacon
but I
unit
think
costs.
Depending on what the property needs. Yeah.
Exactly. Exactly. I think one of the big things, though, that was projected was this continued rent growth at the rates that were experienced. And
just during that time, nationwide, I think rent growth from like 2020 to 2021 was like 40% or like 8% annually. It was crazy.
It's massive.
Yeah, over those 2 years. So and so then how do you get on a pro forma? Well, you just kind of recency bias, you carry that forward and you'll get to your return.
Yeah.
Right?
Yeah.
Well, and then you have the supply issue.
Yeah, 40-year hive supply coming online.
So it was honestly every variable for the tremendous growth. But now we have every variable on the backside of that.
Yeah.
That's going to be a challenge.
And I think it's important to mention, though, when we talk about where we are now or
right.
where we were and where we are now, is that I think something that I believe is critical is that you have to understand your micro market. You can no longer go into a first-time investor. If I were to go into the Carolinas today, didn't know anything about the Carolinas and just throw money at it. Back then, you could probably make money.
Oh yeah,
people were making money.
Yeah,
right, and that's just part of the cycle. But today, it is incredibly important for someone to understand all of the nuances, all of the dynamics of a particular market. You have to. It's critical because that's going to drive the prospects of demand. Rents, where rent's going, your expenses, right? What's capital going to do to chase an investment in that location, i.e. cap rate, right? All the above.
Yeah, basically what happened is now the variables were all playing in your favor. Now the variables, there's a lot of them, are now playing a little bit against you. So you have to be that much more sharp in your operations of a multifamily asset now. It's a complete different animal.
I would say almost any real estate asset. And
Yes.
I just got back from this conference last week. It was a family office real estate conference up in Laguna Beach. And it was interesting. One of the keynote speakers, he's a family office himself, but has advises hundreds of family offices. And he's like, look, anyone could have made money from, pick your date and time, 2015 to 2021, right?
Yeah.
That's why a lot of the family offices started to go direct, not even to not paying the 2 and 20, and essentially no, we'll just manage this. We'll hire a couple MBA $200,000 W-2 guys, and we'll just do it ourselves. But now they're getting crushed, and they're saying, oh no, we're going to go and now find specialized operators and back them and give them that 2 and 20 because it's different
risk.
It's risk. You got
it's like, well, how are we going to learn this market? It's
exactly.
All right, we'll go through a certain operator to do that.
Yeah.
Because everyone specializes mostly on the operations side, unless you cast a huge net and you got over your skis. And that's probably the case in some groups. But some groups probably just niched up and continued to go into certain markets really deep.
Yeah.
Those guys will make it.
Yeah.
Because they're going to know, or they'll kind of know the story of how to get out of it.
Exactly.
Yep.
Yeah. So it's a really interesting time. But one of the other things at this conference that I found was interesting that the institutions are back now. So they were completely pencils down. And so there was a couple $1 billion multifamily shops there. And there was like, hey, we were just bidding on this deal in New Jersey. And we had there's 35 offers. And all the institutions are back because they're buying great deals, Class A deals at between a 5.25 and a 5.5 cap going in. So that's a great yield to me. From a standpoint, it's starting to normalize. And so I think that same way we're getting deals done and we're like, these are great, price per pound deals.
Well, that's what it is. It's the basis.
Yeah.
What does it cost to reproduce that asset today?
Yeah.
And are you comfortable with that?
Yeah, that's the nexus.
That's part of the equation, right? But I think that people look at that hard. And in this part of the cycle,
multi
you do.
too, multi's still really expensive to build.
Right.
Right.
Yeah.
Yeah, and some developers are, they have to push through, and they're finishing, and basically they're break even or losing money, but they have to deliver it, and they just want to sell to get out of it,
to where they can start
and
fill up.
So it is an interesting opportunity for, I don't think it's for everyone, but for the really sharp guys, probably a handful of your clients that are probably looking at this next cycle, and it's probably going to carry through for the next couple of years, where they're buying good deals well below replacement costs.
Yeah.
They're going in at a positive yield or neutral yield day one.
Yep.
And they're like, this is a fantastic 10-year asset, 15, 20-year asset that I'll just continue to hold. And it doesn't matter what rates do, I'll lock in, long-term financing, and then I could play the refi game as we go down the road.
Yeah.
You mentioned something that's another item that I think is incredibly important, and that is when someone is buying something today, there are groups, and many groups do get comfortable with going in negative leverage because they see a clear path to getting, and it doesn't always require astronomical rent growth to do that, right? Again, the operations are key, and if they truly have, if they have some scale in a certain market,
advantage.
Yes, and they understand those marketplaces that they're investing in, and they have an opportunity.
Yeah,
we're seeing groups that are willing to go in with some negative leverage out of the gates, and they're convicted about working out of that in the next 2 to 3 years. And we're seeing people capitalize on that opportunity.
That's where I think the best deals are getting done.
Yeah.
I know that sounds like someone's like, these guys are idiots if they're saying that, but I literally will look at it, if back in the envelope math, right? In our space, price per pound, or, price per pad, or you can see in your world, of your market, know this market, this class, or what's the price per door? You look at that, you look at your going in cap rate. And then what I look at is all right, what's rents, occupancy, and then what's my mark to market, right? Sure. If it's under rented. And then if I clear path that we can get there year 2, year 3, and I have a spread over my debt by 1 to 2 points. Oh, I could underwrite. I could do that in my head and be like, that deal will make sense.
In our space that works though. I don't think that's the case with multi.
It's not the same.
I don't think you have a 2 or 3 year path to rent growth. In fact, I think you should even bake in having to lower rents to the occupancy up.
Yeah. Well, it depends. It depends on the market.
Yeah. It depends on the location.
I agree with you. It depends on the market, right? It depends. The biggest variable is the supply.
Yeah,
what's going on with supply that's been delivered, and what's the absorption going to look like?
Which, New Jersey, probably not a ton of new supply.
Yeah.
Right. So the demand is high.
But that's a harder place to build. That's sort of like San Diego.
Right.
We probably have a decent amount of new supply, but it's not like Phoenix or Dallas.
I was going to say Phoenix,
where you had an open door to develop.
Yes.
Yeah. I think the other thing that's key is from an investor's mindset is, what is my hold horizon, right?
Yeah.
So if you have the financial wherewithal, and operational wherewithal to hold longer term, you're going to be fine.
I agree.
You're going to. Yeah. But if your business plan not only calls for but requires you to be in and out in
5 years or less,
the near or midterm,
good luck.
Probably some risk there that maybe you need to rethink. But there probably are times and places where a shorter term business plan does work, right? If you have operational experience and you're a seasoned investor and there is a unique business plan. But I would say large part, right? Generally speaking, if you have the financial wherewithal, the ability, operational capacity to hold longer term, I think you're going to be in a good place.
Yeah. Yeah. There was a wave of this 3 to 5 year deal, capital that came in where they were trying to just come in, fix up a building, lease it back up at the current rate and sell it. And that got a lot of people in some tricky spots.
Sure. I think on the development front, multifamily coming out of the ground, again, I think the key elements to consider are, what's their land basis? When did they buy that? Right.
So where does this go?
That's what I was just going to ask. What?
I just
knowing what you know with Northmarq, where does this go?
Actually, I had an idea just for fun. If we were on the cycle, we had that run up to 2021. Let's say maybe that's the peak-ish. Where are we on the cycle now?
Coming down. Yeah.
That's a tough question. I can't answer that. I don't know where we're at in the cycle. But I can tell you where we are from what I believe is an investor's point of view.
Yeah.
In buying assets and putting money toward real estate. I believe that it is a good time to buy. I think it's a good time to acquire
on old school principles.
Yeah.
Right.
I mean,
or longer term holds.
Yes. And it's simple supply and demand.
Yeah. Yeah. Go back to the simple.
Yeah.
What's my, right? What's my basis? What's my cost to reproduce the asset or to replace it? And so those simple fundamentals, I think, are really coming into play. And again, the operations component that we had just talked about. But for developers, when did they buy the land? What's their land basis? When did they lock in their cost contracts with their GCs? And what's their business plan? Are they a merchant builder?
Mm-hmm.
Mm-hmm.
How was the deal capitalized?
Yep.
Through the equity. What kind of leverage do they have on the construction debt? Was it private money that took them up to 75% of cost, or was it more traditional construction financing that took them to 60 or 65% to give themselves wiggle room? All of those things are key in not only what decisions that developers are going to make once they get it built and leased up, it's really what decisions are available to them. Because based on some of those choices or what happened, some of the choices of cash in refinance or just a simple cash neutral refinance may not be options.
Well, and the values are maybe 10 years away. If you look at current rents, okay, so you have 10 deals, 10 of these out of the ground or newer construction builds that happen. Just pick, like a broad stroke. How many of them are in a true pickle where they're probably gonna have to walk and the lender's gonna end up with it?
So I would say I don't know about the lender's going to end up with it, but I think a better way to look at it is more a broader sense is, are they going to have to walk? Are they going to have to exit the deal, whether they give it back to the lender or they sell it?
I think
at a price.
Some of them, a chunk, I would even probably say, of newer builds that happened in the last handful of years, like the debt is maybe above what the value is.
Certain markets, that is true. Certain markets, and
it's like, what are you gonna do? Like,
are you
you might as well like ask the lender for a job. Be like, hey, can I manage this for you? Because I'm on the hook here for a long time.
Yeah.
So some of those opportunities are coming to the marketplace. Absolutely. I mean, we're seeing them.
From which side? Principal or lender?
Both.
Okay.
Both. But we are starting to see, and I started to get more wind of it at NMHC this year in January. Lenders talking about probably taking some assets back, right? Some very difficult conversations. Now, are we seeing a wave of that? No, we're not. And will we? We could, but I don't think we will. And the reason I don't think we'll see a wave of it is because there's still a lot of capital waiting to deploy. And
do you think they'll be recapped or just like?
They'll be recapped, or there will be some sort of a structured workout.
Well, so, okay.
Right. I mean, it's
like a short sale type deal.
Yeah.
Where the lenders work
Come
out
back to the table.
Collaborative effort.
Right.
Because they don't want to have to foreclose.
No.
They don't want the property back.
Is that maybe the new sentiment is like lenders don't want to have to go all the way to the mat?
They don't want to. That's time, effort, and labor that really there's, it takes staff.
So will they maybe collaboratively take markdowns?
That's a great question. Time will tell.
What's your bet? I'm trying to pin something down here.
You're trying to pin me down here, right? I don't think we'll see a lot of that. And if it does happen, I don't think it's going to be widely broadcast.
Sure. Well, they don't want everybody to do that.
I get it.
Does that make sense?
Yeah.
I think that you have.
Well, no, you don't want to expose the cracks in the foundation.
No, that's exactly right.
Yeah.
That's exactly right. And so many people learned, from 2007 through 2010, 11, 12. And I believe that people are looking back on those times that they were around. And there's quite a bit of sophistication around distress today. there are opportunities. We're seeing opportunities in the marketplace. We're seeing, some equity groups that were limited partners take control, and some of the GP positions have exited and have gone away. And I think that in some cases, those groups have decided, they have larger portfolios. They're doing well on many of their assets, but some of these that are not, let's just get to a place where we make, minimal dollars or just break even, and let's move on. That's part of real estate risk, is you're going to hopefully win a lot, and there are going to be some that you probably don't do as well on. And that's the reality of it. Right. And I think that these things take time, though. And it was fascinating to me back in, 2022. It was, I'll never forget, it was Halloween of 2022. I had a really good friend who's on the multifamily side of the business, really strong operator group. He's a partner. And he goes, "How you doing?" I was like, "I'm good. Like, things are fine. We're
doing a bunch of deals,
onward and upward." Yeah. It's definitely starting to get shaky.
Yeah.
And he's like, "Survive till 25.
Yeah.
And then we enter 2023. And I remember the whole sentiment of 2023 was, the back half of 2023, we're going to be back. We're going to be back.
Yeah, I remember.
Right. And then 2024, we're going to be back. Don't worry. 2024 is coming. We're going to be back the back half of 2024. And, we're going to be cranking deal volume. And the point of me telling you all of this is that these things take time. They always take longer than people anticipate. And so we are in, to come full circle here.
Yeah.
This was like 10 minutes ago, your question.
Yeah.
I'm going to answer it. We are in a reset. We are in the midst of a reset period.
So in my head, though, if we draw a graph where like the multifamily assets went on this run, it seems like we just kind of have this tabletop moment where we're drifting across the top and maybe starting downwards.
Well, I think that things have gone downward.
Yeah.
Right.
But I still think that they're hiding it. I think there's more there. I think they're extending it beyond where like we've ever thought possible.
That's a consumer mentality, though. Everyone's going to do that, right? If you had an asset that you thought was worth 20 million, and now the market's telling you that it's worth 15.
Yeah.
Unless you're forced to sell it, are you going to sell it?
Well, no, I think those guys are running out of money.
They may be
now.
Their hand may be forced.
So my point is like everyone was waiting, hoping, praying that rates would come down so they could take it out.
Yeah, but here's the next thing. I believe that there's a lot of capital in the marketplace that is waiting for that. And because there's so much capital and so much sophistication, I think that's another element that people need to pay attention to. People are astute to it.
Yeah.
And I don't think that because there's so much money and there is so much sophistication, I don't know that you're going to see the great deal. Are you going to see good deals?
Oh,
Yeah.
well, so I'm with you. I don't think that they'll like go to like this crazy value bottom where everyone can pick them up for 10 cents on the dollar.
No.
My point is I just feel like there's like a lot of the lender stress dynamics happening and nothing's happening.
I know. It's
interesting. They're like, in the day, it's like, well, they're taking action. Lender's now on them and it's moving somewhere.
Yeah. I mean, I'm hearing whispers of it, and I've seen some real life, I can think of 4 deals, which I won't discuss because they're confidential.
Of course.
4 deals across the nation that this year that I've seen, that I've had discussions with and even worked on.
On behalf of lender.
No, on behalf of clients trying to acquire.
I gotcha.
Or even borrower developer in a pickle, right? And so things are there, and it's happening, but not to the degree that you would expect. And part of that,
what you're saying is like you might end up with like a cap rate benefit 1%. Like if it was a 5 cap, you might get it for a 6, or I'm just making something up. But it's like you might get a little bit of a markdown, and you go into a decent as is old principle based math, and you can make sense of the deal. And that's where the deal lands versus like 50% off.
Exactly. I don't think you're buying something at 50 cents on the dollar. I don't think that's happening. But
It's
I
just
do
been slower than I ever dreamed of.
well.
The reorg.
The reason for that is it's the gap
what you're
between
saying.
buyers and sellers. I mean, a seller thinks they want to be a seller until they see what the buyers are willing to pay them.
Mm-hmm.
And they're like, never mind.
And then they rethink it, right? And it's the same with lenders. Like, lenders, and I don't blame anybody for it. Like, I totally get it, but that's what we're seeing in the marketplace. And that doesn't mean deals are getting done. There are transactions happening, but it's challenging. There's still a gap.
To your point with the sophistication, I've heard several, been involved on like the LP side where they're in a pickle, but they don't need to, there's no fire drill, let's say.
Mm-hmm.
And so they'll sell out like a GP stake for 10, 20% of certain assets that are performing
Sure.
to solve their liquidity challenges on the other side.
Interesting.
So that is, to your point, the sophistication piece, which may be like little by little dealing with the leaks in the ship.
I think you're exactly right. I do. I think that the sophistication is solving for a lot of these.
Maybe macro,
Yeah.
the big stuff.
Yeah. A lot of the problems in the marketplace. And I think that, the big opportunities are going to be in the markets where there's less sophistication.
Yeah.
That's what I would say.
Mm-hmm.
That's going to be fun. We're not seeing it in MHC, mobile home parks. We're not seeing a lot of debt challenges,
Yeah.
and we were super lucky with that run in rate on the multi side.
Well, that makes sense because you said that you didn't really see a lot of the bridge.
We
there
were
you go.
always sort of held honest to a decent LTV,
Yeah.
Mm-hmm.
Normal loan to value. No loan to cost ever exists in our space.
Yep.
Like really, maybe a couple guys got it, but very small numbers.
Yeah.
And then with that run in rates on multifamily, we got super lucky because we're the tail of that dog.
Yes.
So we were
Lower
able to
rates.
capture yield and increase revenues
Mm-hmm.
because multi went nuts.
Yep.
So, and we're like, holy crap, we got 4 more years of increases to not be rude.
Yeah.
And how much room they've created for us, even in the Phoenix and Dallas market.
Yep.
Where they're challenged. But what's so interesting is they're all trying to like extend out, maybe do incentives, what do they call it? Concessions on units to where it's like 3 months free, but you hold the $2,500 rents rather than going to $2,000.
Yeah.
There's like a whole
So, I mean,
game being
there's-
played there.
Yeah, there's a lot of that happening in certain markets,
Yeah.
right? And even certain pockets of markets.
Sure.
I mean, it is so localized. It's incredible. But I think just to backtrack a little bit to get back to bridge lending, right? There is still good bridge loans being done today.
Yeah.
And we've talked a lot about the agencies today and bridge lenders in the past, and I think it's important to note that there is a time and a place when it's used appropriately for bridge financing.
Yeah.
Mhm.
Big value.
Absolutely.
Yeah.
There is. And
Yeah.
and there are fantastic bridge lenders, capital sources in the marketplace. I mean, they're good and they serve a purpose. They do it well. But there's a right time and place, even for CMBS money. There's a right time and place for that. And that's why we have all these buckets of capital at, all of our disposals that it depends on the situation.
And
there it
depends
is.
on the client's needs and the business plan, and
Exactly right.
then you can help them make the best
Yes.
debt choice.
Yep.
Yeah.
So, Aaron, one last question for you.
Yeah.
Since you are on the Cashflow Quest, what do you personally do for cash flow?
I keep it simple. I invest in multifamily. I invest in what I know.
Yeah.
Right.
Yeah.
And
I guess that.
yes. Yeah. So it's kind of a little generic.
With
So
operators, or do you do it yourself?
no, operators. Yeah. In a limited capacity. There's as you can imagine, conflict of interest, right? If I were to go do that on my own and in my role. So,
Well, yeah, but you could like own a house with an ADU, or you know what I mean?
well, sure.
Like,
Something like
I
that.
was just curious.
Yeah. It's not really
Yeah, I get it.
my cup of tea.
You want to focus.
And so,
Yeah.
yeah, it's been a privilege to invest with some of my clients. Selectively, I pick my spots. But that's what I do for cash flow.
You also-
Passive cash flow.
Yep.
Yeah.
And then non-passive cash flow, I I go grind every day.
Yeah, that's right.
Top line.
Yep.
Yeah. And hopefully
Cool.
you're able to set some of that off with depreciation and other fun stuff in the real estate realm.
Yes. Yes.
Yep.
Yeah.
Love it, man.
Cool.
Great having you on.
Yeah.
Appreciate all your input. That was a fun conversation about
Yeah,
all
it was
that.
great.
Yeah.
Ton of fun.
Yeah. Thanks for the information.
Appreciate the
It was
invite.
awesome.
Yeah. All right. Thanks
All
for
right.
joining us for another episode of the Cashflow Quest. And we'll see you next time. God bless. See you later.